Ladies and gentlemen, good day and welcome to Tips Music Limited Q1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Miss Ayushi Gupta from MUFG in time. Thank you and over to you, ma'am.
Thank you. Good evening, ladies and gentlemen. I welcome you to the Q1 and FY26 earning conference call for Tips Music Limited. To discuss this quarter's performance, we have from the management Mr. Kumar Turani, Chairman and Managing Director, Mr. Girish Tarani, Executive Director, Mr. Hari Nair, Chief Executive Officer, and Mr. Sushant Dalmia, Chief Financial Officer. Before we proceed with the call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. For more details, kindly refer to the investor presentation and other filings that can be found on the company's website. Without further ado, I would like to hand over the call to the management for their opening remarks, and then we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Ayushi. Good evening, everyone, and welcome to the Q1 FY26 earning call of Tips Music Limited. Despite the challenges faced in the music industry, our catalog and new releases continue to demonstrate resilience, with our revenue recording double-digit growth. The board has declared a first interim dividend of rupees 4 per share for FY 2026. With that, I now invite our CEO, Mr. Hari Nair, to share his thoughts. Over to you, Hari.
Thank you, sir. Good evening, everyone. The strong growth in our revenue has been across digital and non-digital segments. However, we observe a slower growth on the YouTube platform in Q1, probably due to the reduced ad spends and change in YouTube policies. The policies now restrict UGC content usage and monetization. This is good for us as music industry in the longer run, as third-party pirates use our music to monetize from the platform. On the Meta platform, that is Instagram and Facebook, we see a consistent growth for our content consumption. With respect to Spotify, if we compare the paid subscribers last year Q1 FY25 and this year, we see a healthy growth in premium paid subs. Same is the growth for YouTube paid subs also. Overall, we are moving slowly and steadily into a paid ecosystem model. On the operations side, we did a little automation. Our teams have built an in-house content management system called Pulse, which now delivers our content to TikTok and other DSPs via our own DTEX feeds. I will now request Girish to share his insights on the content business across platforms. Thank you, everyone.
Thank you, Hari. Good evening, everyone. In Q1, we saw strong traction. We released 92 songs in FY25, including 48 film songs and 42 non-film songs. The song Main Achti from the film Sonkan Sonke 2 has crossed 75 million views and is charted for 12 weeks on YouTube Top 100. The song from the films Malik and Sarbalaji have performed well and have crossed 102 million views and 51 million views respectively on YouTube. Additionally, we now have 125 million subscribers on YouTube, with a compound aggregate growth rate of 20% over the last 2 years. Our catalog performance on Meta is very heartening. The song Hona Tha Pyar and Dil Hai Tumhara did 500 million and 700 million views respectively. The song Chunari Chunari, the classic Salman Khan song, earned 2 billion views on the platform. Now, I would like to hand over the call to Sushant, who will take you through company's financial performance. Thank you.
Thanks, Girish. Welcome to Q1 FY26 earnings call. I am pleased to share the financial highlights of this quarter. Our revenue for the quarter amounted to rupees 88 crores, resulting in YOY growth of 19%. The content cost increased 85% on a YOY basis as we had new releases, which were expensive during the quarter. Factoring the above, the operating margins came in at 64%, while PAT was at 45.7 crores, resulting in a YOY growth of 5%. With this, I conclude my opening remarks and open the floor for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harsh Shah from Dalal and Broacha. Please go ahead.
Thanks for the opportunity. A few questions from my side. So firstly, how Q1 has kind of panned out, right? So do you still hold on to the 30% kind of revenue aspiration for FY26? So why I ask this question is because if the answer is yes, then for the remaining quarters, the growth that the company needs to deliver would be at least 30%. Yeah, that was my first question.
Yeah. Harsh, actually, it seems because of so many changes in the industry, our entire these Reso OTT platforms, right, like Reso or Ghana or many other people have actually shut down their business or converted their services into a paid world. So we also feel some effect this year, but still I feel we will achieve, happily we will achieve 20%, but still the focus I said earlier, now our new growth will be coming from new titles will support us. So we have a major releases this year. So maybe we still trying, we should achieve a 30% this year as well. So let's be hopeful, but 20% I can see even now we can achieve 20%.
Got it. Secondly, on the contribution from Warner's in our Q1 revenue, if you could give a ballpark percentage, that would be also fine.
Warner percentage will, as said earlier also, between 25 and 30% will be a Warner money coming from Warner's.
Okay, so because why I asked is because in Q4 you had mentioned that for the full year it was around 20 to 25%. So this time around it has gone up, right?
Yes, it will go up this year.
Okay, so then, okay, got it. And lastly, on an industry level question, right? So you did mention in the annual report as well as in the press release as well as in your opening commentary that there are challenges within the industry. So my question is it just because there are music OTT platforms which have kind of closed down, or there could be some other reason, maybe like the ad revenue for YouTube going down, not in terms of say the number of streams which is going up, but the rate that is being charged on YouTube is kind of on a declining trend. If you could give some color on it.
No, touchwood, YouTube is doing good for us, and because of our repertoire, 90s repertoire, is really doing well, and day by day, it's I think is getting more popularity. That Girish just said ki Chunri Chunri has 2 billion views on the Instagram. Our old songs like Dil Hai Tumhara, Hona Tha Pyar, 500 million, 700 million. So you can see ki our catalog still has a lot of strength, and I definitely feel it will be the same impact will be for coming many years, at least 20-25 years. So I feel ki our repertoire is a new retro. We will do well, and we will see growth also. And I'm again mentioning ki we are still focusing to achieve 30% even this year.
Got it. No, so my question was more from an industry level perspective, whether Industry, I can't comment much,
but everybody has the challenges, and the way I am seeing with the other players, they actually everybody is facing difficulty. But because I think the 65, as mentioned earlier, also 65-70% of 90s repertoire belongs to us from 1989 till 2020. So I think our songs are really doing well. So we have edge with the other companies. I feel, this is my opinion. I don't know what they are doing, what their strategies are, what is their numbers. Maybe I hope they will also do good. Actually, entire industry should do good. So it's a good sign for everyone. But I think if we talk only about tips, so that's what we are safe and we are very performing well.
Got it. Yeah, that's it from my side. Thank you.
Thank you.
Thank you, sir. The next question is from the line of Kavish Parekh from B&K Securities. Please go ahead.
Hi, team. Thanks for the opportunity. My first question is on the revenue growth side. So I think when we last spoke, which was around after the results of the fourth quarter, our aspiration for revenue growth was 30%. And today, while you have mentioned that you still aspire and stand by the same number, minimum guidance has, or rather minimum growth that we will aim to achieve will be around 20-odd%. What is it you think that is needed for you to bridge this gap between 20% and 30%? And just wanted to follow up on the comments that you made on YouTube in your opening remarks with respect to some policy changes. Could you explain that a bit more?
Policy change? What policy change?
So YouTube policy changes, you're saying?
Yeah. So UGC का तो change.
Yeah. You explain, Hari, then I'll come in.
So on YouTube, right, there are certain policies that they have implemented where they are trying to reduce the music uploaded by the pirates. So what happens is many people who use our catalog, they remake the song without having the same kind of composition, and they upload it on the platform, which then takes away our money. So it is trying to curb those activities. So that is a little change that we see over there. But again, that should be not a long-term one. It should be a short-term impact only. And we are seeing slightly growth again rebounding in the month of July. So hopefully it should grow. Does that answer your question on the policy side?
On the policy side, yes, but on the overall revenue growth aspirations for FY26, maybe some comments around what is needed to bridge this gap between 20% and 30%?
We really see growth in our repertoire. As mentioned earlier also, our catalog is really doing well and the numbers they are showing. And also now I think Instagram, whatever is happening on Instagram, is helping us on YouTube and Spotify. So I think overall numbers can be, and plus whatever acquisition we have done, and our plan is for new releases this year. So we can achieve that number from 20 to 30%.
All right. Plus the 19% that we reported this time, I think part of that was also impacted by the base quarter, which had one-off revenues from Wink. I think rupees 5 odd crores in the first quarter.
Yeah. Last year, yeah.
Last year, yeah.
Yeah.
And
last year,
12 crores. I think 5 crores in the first quarter, 7 crores in the second quarter.
Yeah.
Right,
yes.
Got it. And for the full year, what is the number that we're thinking in terms of content cost as a percent of revenues? Somewhere around 26 to 28%?
Yeah, 25 to 28%. Yes, that is the number. Yeah.
All right. Thank you so much.
Thank you.
Thank you, sir. The next question is from the line of Vinay from IGE. Please go ahead.
Yeah, hi. Thank you for the opportunity. Am I audible?
Yeah.
So, as the last participant asked for, the percentage of expense to be expensed into content acquisition. So, over the medium term, how it is expected to behave?
Expense on content.
Yeah.
Our target is to spend around 20 to 28%. And if we feel there's an opportunity, we can have maybe increase our investment by 2, 3, 4%. We do that if we have a quality content, which will help us in future. We'll do that, and we'll explain you why our content price has gone up. But as far as this year, what I'm seeing, I think we will be in the range of 25-26%.
Got it.
We won't go.
And what is the policy, accounting policy for us to write off our content expense?
That is same. That is the same. Right? The same quarter. See, if you see this quarter, last year, same quarter, it was around 9.5 crores. This quarter, we have written off 20.5 crores. So we have 3 big films came in, so we have written off everything.
Got it. Thank you. I'll fall back in the queue for further questions.
Yeah. Thank you.
Thank you, sir. The next question is from the line of Garvit Goel from Invest Analytics Advisory LLP. Please go ahead.
Hi, am I audible?
Yeah.
Yes, sir.
Good evening, sir. Sir, my question is around the challenges only. I want to understand more about them. Like last quarter, we were very much confident about 30% guidance. Now we are looking a bit cautious about the guidance. So can you put some color on that? Like what are those challenges? What has happened suddenly, like in last 2-3 months, which the tailwinds in the sector has converted into the headwinds? So can you put some color on that?
See, we should try and do 30%. We are very keen to achieve that number, but for safety and the way I see they are day by day becoming tighter. Like Spotify, they are not allowing people to listen new releases again and again. They tell you to come on a paid wall. So that paid wall simultaneously is increasing, but we don't know how much that growth will be. If there is an excellent growth, so 30% will be very easy to achieve. So we are keeping our, we are applying cautious here, and we are telling you upfront, 20% what we can see, but we are still hoping and trying fully, we should achieve 30%. That is the only challenge we have.
And you also mentioned about some closing down of the OTT platform. So what is that, sir?
Yeah, there is a last year, there was a money came in from Reso, then there was other apps, Wink was doing good business, and then there was Ghana, Hangama, so many apps, they have shut down or they have gone behind the paid wall. But even this year, we are listening to Amazon is now coming, they are launching full-page service like Spotify. Earlier, they used to go only that subscription, what they charge, bundling. So I think many developments like that is happening, and which is good for industry and give a new increment revenue for us and industry.
And we say 20% or 30% the guidance. Our content cost is rising, and we are having a target of 25 to 28% of revenue this year also. So do you think like PAT growth will be 20% in case we are doing the 20% top line, or 30% in case we are doing the 30% top line?
Sushant will explain this. Yeah.
Garvit, let's say when it's 20% growth and with a 25% content cost, so we'll see a healthy PAT growth, yeah.
No, I agree, healthy PAT growth, but the thing is, like quarter also, 19% Y-on-Y revenue growth is there, but PAT is muted, mainly because of this content cost. So that's why I'm asking, like, is the guidance equally applicable for the bottom line as well?
Yes, Garvit, it would be applicable to the bottom line, and you look at on an annual basis, not a quarterly basis.
So annualized basis, minimum 20% PAT growth will be there this year also, right?
Yes,
Got it, sir. Thank you very much, sir. That's it for my side. All the best for the future. Thank you.
Thank you.
Thank you, sir. The next question is from the line of Vaibhav Mule from Yes Securities. Please go ahead.
Hi, congratulations on a strong set of numbers. My first question was around Meta revenue recognition. So you mentioned a couple of songs doing very well on Meta platform. So is the revenue recognized from the streaming that we generated on Meta? And what is the incremental revenue that we are generating from addition of Meta specifically?
See, we can't tell you specifically how much we are doing with Meta or any other app. But in totality, what we give you like 20% or 30%, whatever we do. So please do keep that in mind because it's a competitive world. We can't reveal the numbers, but we are doing well. I can tell you this. Understood, sir. Sir, just on the YouTube views, our YouTube views were sequentially flat and 9% down year on year. I understand there was some impact of on overall revenue because of shutdown and shift to premium model by different streaming platforms. But for YouTube, why is there a 9% year-on-year decline? No, we are not decreasing. Our growth is. We felt our growth will not happen, but again, even in YouTube, we are seeing the growth. So we are positive, very positive about that. Our new releases and our catalog, our repertoire is really doing well even on YouTube. Okay, sir, got it. And just last question on the short format videos or reels. What is the status of monetization of that particular format on YouTube as well as other platforms? Other platforms we are doing well. YouTube we have a fixed deal, but even on YouTube I think this fixed deal is 1 more year, and after that we'll see what's going to happen. Understood. Thank you, sir. That's it from my side. Thank you.
Thank you, sir. The next question is from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. So, sir, just wanted to understand on the video side, and like you mentioned, a lot of copyright and people are changing changing some words and all that thing, and because of that, we are impacting. So, just wanted to understand, is Tips exploring on the AI-driven music recommendation side, and also how to track down the music which is of Tips and using by other composer or musician?
Yeah. So, madam, YouTube has a great fingerprinting system called Content ID that actually automatically scans whenever you upload any piece of content. It scans with this library and tells us or the respective copyright owner that there has been an upload done, or it matches and it gives us a claim. So that part is taken care very well of by YouTube. But there are certain people who try to change the composition a little bit, try to tweak the lyrics a little bit, and then also upload the song in a different way. So they're trying to restrict that kind of monetization, which is kind of piracy. So that is being restricted, nothing else. Did I answer your question?
Okay. And sir, on the subscription versus ad revenue, like global data on the basis of the presentation that shows subscription is seeing generate 3x revenue versus ads supported. So what's our current mix and strategy to grow subscriptions?
That is a question for the platform, madam. We are not probably in the right space to answer that. It's a platform-related question, so Spotify and YouTube can answer that.
Okay. And sir, on the digital ad spend side, if you can explain how is Tips aligning its monetization strategy with this trend?
So again, this is a platform-driven one. So YouTube, if you see every month, there are fluctuations on the ad monies that are spent on the platform. It can be sometimes higher on YouTube, sometimes higher on Insta. So it just fluctuates. But overall, the Indian market it's growing on the ad spend side.
Okay, fine, sir. Thank you, sir.
Thank you.
Thank you, ma'am. The next question is from the line of Swapnil Potduke from GM Financial. Please go ahead.
Hi, thanks for the opportunity. I have just one question. It's with respect to your digital revenues. I think there has been a dip from 76%-75% which you used to report earlier. Now that number has come down to 72%. So, any particular reason for that?
We are doing well on other side, non-digital. So maybe that's the field. But ultimately, it will be between 70 to 75%, and that other business will be in the range of 25-30%. Here and there, it will keep on happening.
But by any chance, there has been any dip in the Warner revenue or any pressures on that side also?
No, nothing.
And this cautious approach when it comes to your guidance of,
Actually, maybe the difference. Hello.
Yep.
Excuse me. Maybe the difference because of Sony Music Publishing, we have a big deal with them, and they are really showing a very good revenue. So maybe because of that, this has happened.
Got it. And when it comes to your cautious approach, when it comes to the FY26 guidance on the revenue side especially, that is entirely linked to this disruption which is happening on the freemium streaming side, especially on the OTTs, or that also has some part of YouTube views not growing the same way that they were growing earlier.
You can say 70-80% to the OTT because of OTT have taken a different kind of a view on the entire business, and maybe 15-20% on YouTube as well.
Do you think that YouTube growth views is kind of a structural challenge?
Earlier we used to estimate that YouTube will grow by 25-30%, but now we calculate that YouTube will grow by at least 15-18%.
So does that mean that your growth assumptions for beyond FY26 also will factor in lower YouTube growth? And
No, I don't think so, because as I mentioned earlier, our catalog is doing well. Plus, we have a very quality new songs coming in this year and as well as next year. So I feel we will achieve our targets.
Okay, got it. Good. Thank you.
Thank you.
Thank you, sir. The next question is from the line of Deepak Ajmera from IGE India. Please go ahead.
Yeah, hi. Thanks for question. You mentioned YouTube contract will be renewed next year. So what we should expect from that renewal? It is like some sort of increase, or we are moving to different methodology. How should we look at it?
It's next year YouTube Shorts, short service, that contract is getting over. But it's very early to say anything about that. We have not started talking to them. We will formalize in the next 6-8 months. We will talk to them and we'll come to some conclusion. But I feel it will be a raise. But our main target is to be, this also should be a per view or per stream basis. We should get money like that. But at present they are giving us lump sum kind of a deal. So let's see what industry other players are doing. What is our requirement? We'll talk to them. We'll negotiate harder. We tips negotiates very hard.
Got it. And one more point on the YouTube viewers. Means other OTT players are charging fees, and therefore may impact it. But why the viewership is going down in YouTube? Any specific reason which you can highlight?
Yeah, that's mainly due to shorts, so it keeps on fluctuating. So YouTube short views keep going up and down. That's very cyclical.
Thank you. Thanks for this.
Thank you.
Thank you, sir. The next question is from the line of Karan from Keynote Capitals. Please go ahead.
Hi, thank you for the opportunity. I have one question, which is, what proportion of your content consumption, is currently coming from the short format platforms like Reels or Shorts? And because they are not fully monetized like other audio OTT platforms, is that impacting revenue growth? Like, is the shorts format growing faster than the traditional audio OTT formats for tips?
Yeah, it's growing very, very well. And we can't actually tell you the number, total number, but it's really way ahead than normal other songs or other views.
Okay, understood. Thank you.
But this doesn't impact our business.
It's not impacting the traditional consumption. That's also growing in parallel because somewhere the shorts content is also promoting our long form content. So that's growing in parallel. So it's not eating away into anything. It's, if anything, helping and reach out to a better number overall.
Okay, but since we are not getting paid on a per view basis, it's not impacting our revenue growth despite it growing really fast?
So yeah, shorts are done in a lump sum basis, so that remains unaffected regardless of how many views it does. But because the views on short content is growing, that's helping our long form content, and from there we are then generating more revenue. So in some ways, helping us. And once I think industry-wide, once the model is set out to have this short views in one, whatever, per reel, per creation or per consumption basis, then that will also amplify further. So it's just a matter of that one switch over to happen.
All right, understood. Thank you.
Thank you, sir. Ladies and gentlemen, to ask a question, please press star and one now. Participants who wish to ask questions may please press star and one at this time. The next question is from the line of Dinesh Kulkarni from Finsight. Please go ahead.
Hello, sir. Am I audible?
Yes, sir.
Yes.
Okay. Thank you, and thanks for the opportunity. Sir, my question is more on capital allocation. See, if we, sorry, our content cost has almost doubled, that's a good sign. But at the same time, we are saying that we will, give out a good portion in terms of dividends as well. So how do we see, the capital allocation strategy or policy for this year and in the medium term?
Yeah, our CFO, Mr. Sushant, will tell you. Yeah, Sushant.
Dinesh, let's say we write off our content cost in the P&L immediately at the time of release, and then whatever the PAT remains, we distribute it in form of dividend. So our allocation towards content is in that range what we have guided between that 25 to 28%, and post that we pay the dividends.
Last year's revenue.
And let's say as a policy, what we have formed is whatever is the last year's PAT, we will distribute as dividend in this fiscal year. So let's say last year we earned around 166 crores in PAT, so that will get distributed this year in form of dividends.
Okay, so this is not from the current quarter earnings, right? It is predominantly from the last year earnings. Oh, okay, that sounds great, sir. But I just wanted to also understand, sir, how does the I know may not be the right metric to ask, but say like if we are adding almost 100 songs per quarter, and again at the same time our content cost is almost increasing, how do we see this trend per song? Is there any metric which you follow? Like, okay, this is my target per song, and okay, this much max we can offer per content per cost, and is there any metric which you look at? Any KPI sort of a thing?
So, Dinesh, in terms of per song won't be the right metrics because film songs and non-film songs cost vary on a high degree. Primarily, let's say we have a fixed budget. Let's say for this year, let's say we are targeting 25 to 28% of our revenue to be spent on new content. So we go by that budget.
And we just try to fit in X number of songs in that, right? Just like say,
on the content quality.
Yeah.
It's more on the quality content we are targeting, not in terms of the number of songs.
Okay, that sounds great, sir. Okay, thank you very much, sir, and all the best. Yep.
Thank you.
Thank you, sir. Participants who wish to ask questions may please press star and one at this time. The next question is from the line of Vineet Lambu from HSBC Asset Management. Please go ahead.
Can you hear me?
Mr. Vineet,
Can
your
you
line
hear me?
has been unmuted.
Can you hear me?
Yes,
Yeah.
sir. Your
Hello.
sound is very low, sir.
Hello. So
Yeah,
I
Vineet.
wanted to ask, like the slowdown majorly is due to the increased nature of the payment wall on the content by all the platforms, or is it because of the takedown of imitating accounts which are trying to imitate your content?
We can't hear you, Vineet.
Sorry, I'll fall in line. Sorry.
Yeah. Hello?
Can you please repeat your question?
He'll rejoin. Moderator, we can move to the next question. In the meantime, Vineet is rejoining.
Okay, sir. The next question is from the line of Yashodharan Agarwal from IIFL Capital Services AMC. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yeah.
Yes, sir.
Yeah. Thank you, sir. Thanks for this opportunity and congratulations on good set of number. So my question is that currently we are witnessing that many of the platforms are going behind the paywall, correct? But since they are going behind the paywall and if a content is getting consumed on that platform, so the realization of that content would significantly be higher as it was earlier. So isn't it true that the gain that we are looking over there is partly more than compensated than what the volume that we have lost over there?
I think over a period of time it will happen. What you're saying, it is so right now the paid subscribers are there, but the volume is not so high that it will negate the consumption streams that happened on the free side. So as it's steady, I think what you're saying will happen over a period of time.
Got it, sir. But sir, at the same time, if I look at the consumer behavior, and if I want to consume the content of Tips Music, and I am unable to hear it on the platform which has gone behind the paywall, then I will probably go to some other streaming or the music OTT where I can consume it for the free, probably on the YouTube. So the consumption should happen over there, which should result in significant increase in volume of that particular streaming. So at the end of the day, our content is getting consumed, so growth should come over there. So isn't that happening?
Yeah, that is happening already. So if you see Spotify, they do give away free usage to the consumers. And if you search for any tips content on Spotify, Ghana, anywhere, you will get the content. It's just that some platforms have opened up only paid ecosystem, like Ghana moved to a completely paid ecosystem. You can do a trial for 30 days, but after that you have to pay. In Spotify, they have free usage for a limited period of time. They try to do new obstructions, but eventually you are able to search the content, either Spotify or YouTube, Ghana, Amazon, Apple, all platforms you are able to search the content.
Got it, sir. And so do we track the growth in terms of volume, that how much of a content is getting consumed in terms of streams or views? So views we disclose in the PPT. So in terms of streams, do we track that, and how is the growth over there?
We track that, but we'll not be able to disclose the absolute numbers. But we are seeing a growth in our catalog consumption across all this audio streaming and video streaming platforms.
Got it, sir. But the growth over there is meaningful. Is that right, Ramesh?
Yes, it is growing, and it is steadily growing. It is meaningful.
Got it, sir. And my last question is that earlier we had disclosed that payback period for the content that we acquire is 5 years. So does that still hold true, or due to competition it has increased?
Sorry, could you repeat that?
Yes. So my question is on the payback period of the content that we acquire. So is that 5 years, or has that increased or decreased?
We always say internally we want our payback should be within 3 years. But people like you, we say, please keep it for 4 to 5 years. But there is a big catch here. We write off entire content in the same quarter. So we don't have any burden on our head. In 5 years के बाद, in case our content is not doing that, so we have a huge write-offs to make happen. So we don't do that. So we believe in, and this policy we are doing from beginning.
Very true, sir. No, so the reason I was asking that question is that the payback period would be dependent upon the quality of the content. That if the quality is good, more people are listening to it, and the payback period would be less. So that is why I was asking the question that is there a change in that or not? But you have answered it. So that's it for my side.
It's the same thing. We want 3 years, but people like you, we are saying 5 years. Please keep that in mind.
Got it, sir. Got it. Thank you so much and good luck.
Yeah. So I'd like to just add here, somewhere that's why we are a little careful about our expenses also, because we want to invest in content which will give us this result. There's no point in investing in content that we don't see a future in. So we are working with the correct makers, trying to work with the correct talents, and trying to involve ourselves creatively to get the best and extract the best out of our content acquisition and reward all shareholders, basically.
Got it, sir. Thank you.
Thank you, sir. The next question is from the line of Shreya Garg from Yashvi Securities. Please go ahead.
Hello.
Yes, ma'am. Please
Yes.
go ahead.
Hi, am I audible? Yes, hi.
Yes.
Thank you for taking my question. I wanted you to elaborate on the in-house content management team that you had mentioned in your opening remarks.
Yes.
From the operational angle, how will it be different than, how will basically the content acquisition process going to be different than what was being done earlier? Also, can we expect a hike in the employee cost as a result of this addition in team?
Yeah. So content acquisition is completely different. This is content operations. The way we used to work earlier, now it is completely automated on a system called Pulse, which is in-house developed by our teams. And we have a capability increased that we can deliver content using our own DDEX feeds to players like a TikTok or Spotify or YouTube in the future. So it's like going direct instead of going via others.
All right. So like this team is an addition to your current employee base. So will we see a addition in the employee cost?
No, so this actually the team is in-house only. There's no addition in the employees. The existing teams are only helping to build this. We also have an analytics layer on top of this operations that helps us in our business management.
Okay, thank you and all the best.
Thank you.
Thank you, ma'am. That was the last question for today. On behalf of Tips Music Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.
Thank you, sir.
If you found this video helpful, please like, share and subscribe for latest upcoming videos.